I'm Grant Webster, CEO of THL. This is an opportunity to provide you a short overview of the results for the last financial year ending June 30, 2016. For more detailed information, please do refer to our website, check out the financial statements and associated presentation. Our net profit after tax for the year was another record at $24.4 million, well up on the prior year. Pleasingly, our revenue was also up 18% to $279 million. We're serving more customers in more locations and having them spend more with us along their journey as well. We also announced this year a dividend increase to 10 cents per share for the final dividend. That takes it to 19 cents for the full financial year, and pleasingly 6 periods in a row that we've increased our dividend spend. Over the last few years, I've talked about our relentless focus on ROFE, or returns on funds employed. It was pleasing in the last year that we had another increase to an average ROFE of 15.1%, up from the prior year's 12.9%. Let me give you an overview of the results and the key highlights for the business from my perspective. In the last year, we continued a number of business model changes, as well as seeing improvements from the core business. Overall, we invested $2 million in additional costs to fund a number of new initiatives. The largest and most substantial of these initiatives was the launch of MyWay, a sharing economy platform for RVs or motorhomes here in New Zealand. MyWay provides private owners the opportunity to take part in the booming tourism demand in New Zealand. At the same time, it gives THL the opportunity to maximise our opportunity within that demand with less capital employed. We're going to continue with MyWay this year, continue to invest in it, and we'll explore the opportunities to potentially take MyWay offshore. The second initiative that we've spoken a lot about over the last 12 months is our Flex Fleet initiatives. We've deemed those a real success in the last 12 months, both from a rentals perspective and a sales perspective. We'll continue to grow our Flex Fleet initiatives across New Zealand and Australia very carefully over the coming 12 months. The telematics trial in Australia, while slow to start, has really gained momentum in the second half. It provides us with an opportunity to carefully influence customers' driving behaviours and habits and create resulting cost savings for us as an organisation. We have increased our customer engagement throughout the year as well with the launch of in-vehicle tablets in New Zealand and Australia rentals. These provide customers with an opportunity to engage with more experiences, get more information, and have a much simpler on-road process as they move around the country. Check out the app Campermate to see some of the technology that sits in behind these new activities that we've launched. Lastly, we also invested in new sites. In Waitomo, we purchased a restaurant, refurbished it, and launched the Waitomo Homestead. It's exceeding our expectations, and we think it's got a really positive future. In the USA, we opened a Seattle branch, which is also exceeding our business case expectations. Let's take a quick trip around the businesses around the world. Starting with New Zealand rentals. Our EBIT improved 26% over the prior year. We had strong rentals business, a very strong sales business, and yet we still see improvements and opportunities in the coming 12 months. Australian rentals. An okay result with an 11% increase in EBIT. We do see more opportunities in the year ahead with the likes of the telematics initiatives and other cost savings coming to fruition throughout the year. In the USA rentals business, we had a stellar 40% increase in EBIT in New Zealand dollar terms. We performed really well operationally, but also had some strong headwinds with the currency translation between USD and NZD earnings. Moving forward, we still see growth opportunities in the US, but in FY17 we will be investing in more infrastructure and more crew and people to make sure that we have a sustainable business given the growth that we've had over the last few years. From a tourism perspective, we've had a very positive year with a 30% increase in EBIT. Pleasingly, we're seeing more customers from the China market and we're growing market share in that area, a real focus for the team over the last couple of years. Action Manufacturing had a good year given that there were some one-off items the previous year, and they managed to again deliver a lower build cost for our THL motorhomes. Just Go, our joint venture business in the UK, had an okay result for the financial year, its first full year in THL, but pleasingly created a very strong platform for growth into FY17. Our group costs, as mentioned before, have increased as we've invested in new initiatives, but stayed in line with our internal expectations. Over the year, we also brought a number of new talent into the business and pleasingly saw some internal appointments to some key vacant general manager roles across the business. So overall, the outlook for THL remains really positive. Tourism worldwide is still on a growth path, especially here in New Zealand. We'll provide more information about our outlook and our forecast for the financial year 2017 at the annual meeting in October. We're also pleased though to reinforce our target of 30 million net profit after tax in 2 years' time in FY18. Again, as I said at the start, have a look on our website for the financial statements, a more detailed presentation, and I look forward to seeing you at the annual meeting in October for a further update.